This is Matt Heisler from Vanderbilt Properties, and today in this video, we're going to talk about a very popular topic I know for first-time buyers, especially since they worry about it because it can be expensive. And so what we're going to talk about here is we're going to talk about closing costs and exactly what they are. We're going to tackle the three different kinds of closing costs, right? And then as we talk about them, we're going to give plenty of examples and we're going to show you how to compare loans and all that good stuff. But before we get started, I'm just going to say again, I'm Matt Heisler. I'm the broker owner of Vanderbilt Properties here. I've been selling real estate for over 22, 23 years. I'm not an attorney and I'm not a lender. You know, it's always a good idea to talk to a lender about this, but this is sort of my take on closing costs. I've certainly looked at enough closing statements to do this kind of overview and make it helpful and simple for people. So I break them out into three different types. Basically, there are what I consider the true closing costs. A true closing cost to me is money that goes to somebody else so that you can close the loan. So if you need to pay your mortgage guy $1,000 so that he can prepare the docs and get the loan for you, that's a closing cost, right? Because you're not going to get the $1,000 back. If you need to pay the attorney in order to close, or the title company in order to close the loan and record the house, well, you're not getting that money back. That goes to the attorney for doing that work. So all of those things I consider general closing costs. But there are other things that the lenders generally consider closing costs, and this can make it very difficult to figure out how much the closing costs really are. A lot of those things are actually what I consider prepays, and I don't really consider them part of the closing costs. Prepays are money that you advance yourself for a future bill. So a prepay is very commonly for the loan itself. It's very common that you need to pay the bank a certain amount of money either to start the escrow fund or to take care of the last few days of the month. There are all sorts of reasons why you need to do this kind of prepay for the loan, but this is money that ultimately you pay for owning the house, not for buying the house, right? And it's the same thing with taxes. It's very common for buyers to have to prepay a certain amount of taxes, again, either to put it in escrow or because the seller has already paid this money and you need to pay the seller back. But either way, this is money for living in the house, not for buying the house. Home insurance is another very common item that we see as a prepay. You use the home insurance, it protects your house, and so this is a bill that you would have to pay to use the house. And so I consider that again a prepay. Now, what's important is a lot of prepays, they vary depending on how expensive the house is. So $1 million house is going to have a lot more money for taxes and mortgage and home insurance. Those things are all going to get more expensive. For an inexpensive house or a condo, those things aren't going to be anywhere near as much. So once you strip out the prepays, what you're really looking at is the actual closing costs of that particular loan. And believe it or not, whether you're buying a $2 million house or a $150,000 piece of land, the closing costs are relatively fixed for most loan types. There are exceptions, and one of those exceptions is actually the third type of closing cost. It's points. Now, points are very confusing, especially to people who are not super financially literate about how mortgages work. But the simplest way I can explain points is that what you do is you actually use cash, today's cash, to have the bank offer you a lower rate for the entire term of the mortgage. So if you plan on holding that mortgage for 30 years, paying points can be a pretty good deal because that loan has 30 years to pay you back. Buying that particular point saves you, let's say, $150 a month. It's going to be 20 months before you get your 3 grand back. And then eventually you're going to start saving that $150. So points can be a really good idea at certain times in the market if you have the cash, but it does increase what you're going to pay for that particular loan. When interest rates are relatively high, as they are now, it doesn't make any sense to buy points at all because the chance that you're going to refinance in the future is pretty high. It is very likely a year from now or a year and a half from now, rates are going to be substantially lower than they currently are. And if that's the case, then the money that you spend on points today is wasted because when you refi, you got to start all over with this closing cost stuff. That's really all I'm going to say on points. It really deserves a much larger, longer video. And I've just sort of given an overview here. And now we're going to move on and we're going to talk about how do we compare loans. So if you're calling a couple of different lenders, and I always tell people it's a good idea to make sure they know it's a competitive situation. First of all, because a lot of them are very disappointed if they don't get the loan. And so you really sort of want to make sure that you're getting their best rate by telling them that it's competitive up front. But what you need to do is you need to ask for a GFE or a predicted closing disclosure. And those things they are required to give you. Now, the lenders know that people go out there and loan shop, and that's normal. But they tend to lump the kinds of things that I just talked about into the loan when they're giving it to you. And then they sort of hope that maybe you don't ask a lot of questions to untangle it. And I'll tell you, the first time that you look at a good faith estimate, it will probably be pretty confusing and it will be hard to figure out exactly what is what. So, your best defense is to find someone who has looked at quite a few of these closing disclosures, and hopefully they can walk you through and explain to you what the closing costs are. If you've done this correctly, for a lot of buyers, your closing costs are probably going to be somewhere between $2,500 and $4,000, which is a pretty big range, but you'd be surprised how many times they end up around that $3,000, $3,100 number. Now, again, if you roll in all the prepays, they're going to be a lot more expensive than that. So this number is based on you correctly identifying and pulling out all the prepays that are in your GFE. I'm going to put a note in here about title insurance. Title insurance deserves its own video, so I'm not going to go over it. There's two different types. It can be hard to figure out exactly what it is, but typically when you're comparing good faith estimates, they will only put the bank's approximate cost of title insurance on the GFE. They won't put the owner's title insurance. I think for the most part, you can probably just take title insurance out of the equation when you're looking for closing costs, but it kind of is a closing cost. But I would probably take it out if I was trying to get an accurate number as to what the closing costs were so that you can shop loans. Okay, that's all I have today for closing costs. I do have more examples here on the blog post on the blog if that's how you found this video. And if you found the video just through YouTube, remember you can check out closing costs on my blog at the link below, and hopefully you'll get even more of your questions answered. Thanks so much.